I've been thinking a lot about this whole dividend investing craze lately, and I've got to tell you something that might surprise you. Everyone's running around talking about 12% yields in covered call ETFs and how to generate $4,400 a month. And let me be honest with you, most of it is nonsense. Complete nonsense. And I should know because Warren and I have been doing this for over 60 years now. And we made plenty of mistakes along the way to understand what actually works. Let me take you back to something that shaped how I think about all of this. It was the early 1930s, you see, and thanks to the behavior of the capitalists in those robber baron days, stocks were yielding dividends that were twice as much as the interest rates on bonds. Think about that for a moment, twice as much. It was a wonderful period to be buying stocks because we profited from others, demoralization from the previous generation. The Great Depression, the crash of 1929, it left scars on people like Ben Graham that lasted their entire lives. Ben's ideas about how to value companies were all shaped by how that crash almost destroyed him. It left him with an aftermath of fear for the rest of his life, and all his methods were designed to keep that fear at bay. But here is what I learned from living through all of that, and it is something Warren and I talk about all the time, the desire to get rich fast. That is pretty dangerous, always has been, always will be. And when I see people chasing these high-yield dividend strategies, promising you financial freedom in just a few years with some covered call ETF yielding 12%. My first thought is, what is the catch? Because there is always a catch. Now, before I go any further, let me tell you something about how I think about dividends differently than most people do. Most folks, they see dividends as this separate thing, this payout that is somehow divorced from the business itself. But that is not how Warren and I look at it at all. When we bought CS Candies back in 1972 for $25 million, we didn't know the power of a good brand. We really didn't. But over time, we just discovered that we could raise prices 10% a year, and no one cared. Nobody cared. Learning that changed Berkshire forever. It was really important. You see, what we discovered with CS wasn't just about the dividends it paid to Berkshire. It was about something far more important. The business generated cash, real cash, that we could take out. That is what dividends really are. They read the cash a business generates that it can use efficiently in its own operations. And here is the critical distinction that nobody wants to talk about. There are two kinds of businesses. The first earns 12%, and you can take it out at the end of the year. Beautiful. The second earns 12% too, but all the excess cash must be reinvested. There is never any cash to take out. It reminds me of the guy who looks at all of his equipment and says, "There is all of my profit." We hate that kind of business. So when someone shows you a dividend yield, whether it is 3% or 12%, the first question you should ask is, how much am I getting? The first question should be, is this a great business that is generating real cash, or is this some financial engineering trick that is going to blow up in my face? Let me tell you about diversification for a minute, because this is where everyone gets it completely wrong. This worshiping at the altar of diversification, I think that is really crazy, completely crazy. The investment world has this obsession with spreading your money across 50, 100, 200 different stocks. They tell you it reduces risk. And you know what? For most people, they probably right, because most people don't know what they doing. But here is what they want to tell you. If you really understand business, if you really understand quality, you don't need 50 stocks, you need 5, maybe 10 companies you understand so well that you can sit on your ass and just let them compound. I call it sit on your ass investing. You are paying less to brokers, you are listening to less nonsense, and if it works, the tax system gives you an extra 1, 2, or 3 percentage points per annum. But here is the thing, and I want you to really hear this. If you buy something because it is undervalued, then you have to think about selling it when it approaches your calculation of its intrinsic value. That is hard work, constant work. But if you can buy a few great companies, really great companies, then you can sit on your ass. That is a good thing. Now, everyone us talking about this video that is going around about Warren explaining how to live off dividends with $4,400 a month. And V got all these strategies: blue chip stocks, dividend growth stocks, covered call ETFs. Let me address each one of these from how I actually think about it, not how some financial advisor who has never built anything wants you to think about it. Blue chip dividend stocks. Okay, there is some wisdom there. Warren said it himself, and I agree with him completely. The most important quality for an investor is intellect. It is temperament. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. And blue chip stocks, companies like Coca-Cola that we've owned for decades, they can provide that steady stream if, and this is a big if, you buy them at the right price and you hold them forever. But here's what they don't tell you in these videos. Our favorite holding period is forever. Not 5 years, not 10 years, forever, because that is when the magic of compounding really works. You know, I succeeded because I have a long attention span. That is it. That is the secret. It is waiting that helps you as an investor, and a lot of people just can't stand to wait. Think about what that actually means in practice. You have to be very patient. You have to wait until something comes along, which, at the price you are paying, is easy money. And that is contrary to human nature, just to sit there all day long doing nothing. Waiting. It is easy for us at Berkshire because we have a lot of other things to do. But for an ordinary person, can you imagine just sitting for 5 years doing nothing? You don't feel active, you don't feel useful, so you do something stupid. And that brings me to dividend growth stocks. Now this is interesting because the video talks about companies that not only pay dividends but consistently increase them over time. And yes, there is real power in that, if you find the right companies. But here is what I want you to understand. A great business at a fair price is superior to a fair business at a great price. Always has been, always will be. Let me give you a concrete example of what I mean. Say you've got company A and company BC. Company costs $200 per S hair, earns $10 per S hair, pays out $5 in dividends. Company B costs $100 per S hair, earns $8 per S hair, pays out $8 in dividends. On the surface, company B looks better, right? Higher yield, you are getting more cash today. But what if company A can grow its earnings at 10% per year for 20 years, while company B's earnings stay flat? After 20 years, company A would be worth far more than company B, and its dividend would be far larger too. But you had to have the temperament to wait. That is what betting on the quality of a business really means, and averaged out. Betting on the quality of a business is better than betting on the quality of management, though very rarely you find a manager who is so good that you are wise to follow them into what looks like a mediocre business. Now let's talk about these covered call ETFs, because this is where I really start to get uncomfortable. The video shows these funds yielding 12%, and they reselling call options on top of their stock holdings to generate extra income. And the mathematics look attractive, right? To generate $4,400 per month, you need about $440,000 in a covered call ETF at 12%, versus $1.76 million in traditional dividend stocks at 3%. Sounds great on paper, but let me ask you something. If you intelligently trade derivatives, it is like a license to steal, so you can understand why they all want to do it. But what is the big plus in having everyone gamble with everyone else? I lived in a world with low gambling for decades when I was younger, and I liked it better. I think it was better for the country. It is like having thousands of professional poker players. What damn good are they doing for anybody? Here's what they're not telling you about these covered call strategies. When you sell a call option, you are capping your upside. You are saying, I'll take this premium today, but if the stock goes up a lot, I have to sell it at the strike price. You are trading potential long-term gains for current income. And you know what that reminds me of? It reminds me of eating your seed corn. You are consuming today what could have compounded into something far greater tomorrow. There is more dementia about finance than there is about sex. People get so caught up in clever financial strategies that they forget the basics. And the basics are simple. Find great businesses. Buy them at fair prices, hold them forever. Let the cash compound. Let me tell you about risk. Because I think the way most people think about risk is completely backwards. If you are not willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you are not fit to be a common shareholder, and you deserve the mediocre result you are going to get. Think about that, 50% declines. I've seen them in 1929, in 1932, in 1974, in the early 1990s, in 2008. If you live long enough, you will see them. So when someone tells you they can generate consistent 12% yields with low risk, I want you to understand what they really saying. They saying they can predict the future. They saying they can time the market. They saying they smarter than everyone else. And you know what? I've never been able to predict accurately. I don't make money predicting accurately. We just tend to get into good businesses and stay there. Conservative investing and steady saving without expecting miracles. That is the way to go. Some people in any room can figure out how to average twice the rate of return of the market. I can teach everyone else to do it. It is pretty difficult. Now, I want to address this idea of financial freedom that everyone is chasing. They show you these numbers, $400, $400 a month, and they make it sound like once you hit that number, you are free. But let me tell you something I learned a long time ago. Freedom doesn't come from a monthly paycheck, whether it is from a job or from dividends. Freedom comes from understanding what you don't know. Knowing what you don't know is more useful than being brilliant. Acknowledging what you don't know is the dawning of wisdom. And here is what most people don't know. They don't know the difference between a good business and a bad business. They don't know how to value a company. They don't know their own temperament. People are trying to be smart, and all I am trying to do is not be idiotic. But it is harder than most people think. You see, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. There must be some wisdom in the folk saying, it is the strong swimmers who drown. So let me give you a framework for thinking about dividend investing that is based on what actually works, not on what sounds good in a YouTube video. First principle, view a stock as ownership of the business and judge the staying quality of the business in terms of its competitive advantage, not its current yield, not its dividend growth rate, its competitive advantage. Can this business still be earning superior returns 10 years from now, 20 years? 50 years, second principle. You are looking for a mispriced gamble. That is what investing is. And you have to know enough to know whether the gamble is mispriced. That is value investing. A dividend yield by itself tells you nothing about whether a stock is mispriced. You need to understand the business, the industry, the competitive dynamics, the management, everything. Third principle, move only when you have the advantage. You have to understand the odds and have the discipline to bet only when the odds are in your favor. Remember, good ideas are rare. When the odds are greatly in your favor, bet heavily. But that means 99% of the time you are doing nothing, just waiting. I remember telling people the way to get rich is to keep 10 million in your checking account in case a good deal comes along. They thought I was joking. I wasn't joking. Having dry powder, having the patience to wait for the right opportunity, that is more valuable than any 12% yield ETF. Fourth principle, successful investing requires this crazy combination of gumption and patience, and then being ready to pounce when the opportunity presents itself. Because in this world, opportunities just don't last very long. Think about what that means for dividend investing. It means you can just automatically invest in high-yield stocks every month. You have to wait for quality companies to become available at reasonable prices. We have a history, when things are really horrible, of waiting in when no one else will. That is when you get the best bargains. During the 2008 crisis, during the 1973 to 74 crash, those were the times when great dividend paying businesses were selling for nothing, but you had to have the temperament to buy when everyone else was terrified. Let me talk about something that nobody discusses in these dividend investing videos: taxes and costs. In terms of business mistakes that I've seen over a long lifetime, trying to minimize taxes too much is one of the great standard causes of really dumb mistakes. Anytime somebody offers you a tax shelter from here on in life, my advice would be don't buy it. But here is the thing about long-term dividend investing done, right? If you buy great companies and hold them in a taxable account, you are only paying taxes on the dividends you receive. You are not paying capital gains taxes every time you rebalance or trade. That tax deferral, compounded over decades, is worth more than any clever tax shelter. And costs, my God, the costs. Everywhere there is a large commission, there is a high probability of a rip-off. These covered call ETFs. They got management fees, they got trading costs, they got all kinds of hidden expenses, and those costs compound against you over time, just like returns compound for you. Let me tell you what I think is a reasonable expectation for dividend investing. If you can find great businesses, companies with real competitive advantages, and buy them at fair prices, you might be able to generate a 3 to 4% dividend yield that grows at 5 to 7% per year over time. That means your income doubles every 10 to 14 years without you having to do anything. That is the power of compounding. But to get there, you need capital, real capital. If you want $4,400 per month, that is about $53,000 per year. At a 4% yield, you need $1.3 million invested. And you know what? There is no shortcut to building that capital. You have to save it. You have to be patient. You have to live below your means for years, maybe decades. It is in the nature of stock markets that they go down, so people suffer then. But if you are investing for dividends properly in great businesses that can maintain and grow their payouts even during recessions, those market declines shouldn't matter to you. In fact, they should be opportunities to buy more shares at lower prices. I want to address one more thing that really bothers me about how people approach dividend investing today. They treat it like a replacement for a job, a way to retire early and never work again. But Warren and we never thought about it that way. We love what we do. We do it for free. The money, the dividends, they read just a scorecard. If people weren't wrong so often, we would be so rich. Think about what that means. Our wealth came from other people's mistakes, from people chasing hot stocks during bubbles, from people selling great companies during panics, from people doing stupid things with their money because they were impatient or greedy or fearful. So if you really want to build wealth through dividend investing, here is what I tell you. Start with the business, not the yield. Ask yourself, would I want to own this entire business if I could? Do I understand how it makes money? Does it have a competitive advantage that will last? Is the management honest and capable? If you can answer yes to all of those questions, the dividend yield doesn't matter. Next, be patient, really patient. You might have to wait years for the right opportunity to present itself at the right price. That is okay. As long as you are saving money and learning about businesses, you are making progress. Then, when you do find a great business at a fair price, buy it with the intention of never selling. Treat it like you are buying a farm. You wouldn't buy a farm this year and sell it next year just because someone offered you 10% more. Would you? You buy the farm because you like the long-term economics of growing crops on that land. And finally, ignore the noise. Ignore the daily stock prices. Ignore the quarterly earnings reports. Ignore the analyst recommendations. Just focus on whether the underlying business is still great and whether it is still returning cash to you as a shareholder. Let me tell you about municipal bonds for a minute, because there is a story I love that illustrates this perfectly. When I came out to California, there was this playboy who spent all his time drinking heavily and chasing movie stars. His banker called him in and said he was very nervous about his behavior. The playboy told his banker, "Let me tell you something, my municipal bonds don't drink." That is the mentality you want with dividend stocks. You want businesses that don't require constant attention. Businesses that just keep generating cash year after year, decade after decade, regardless of what is happening in the economy or the stock market. Now, I know what you are thinking, Charlie. This all sounds great in theory, but what about right now? What about with inflation where it is, with markets at all, time highs with all the uncertainty in the world? And my answer is the same as it has always been. I think that one should recognize reality even when one doesn't like it. Indeed, especially when one does like it. Reality is that there are no easy answers. Reality is that there are no easy answers. Reality is that building real wealth takes time, patience. Reality is that most get rich quick schemes, including these high-yield dividend strategies promising financial freedom in a few years, are too good to be true. But here is the good news. Reality is also that great businesses exist. Reality is that they create value over time. Reality is that if you are patient and disciplined, you can participate in that value creation. You do get an occasional opportunity to get into a wonderful business that is being run by a wonderful manager. And of course, that is hog heaven day. But those days are rare. Most of the time, you are just waiting, just being patient. We just keep our heads down and handle the headwinds and tailwinds as best we can, and take the result after a period of years. That is all you can do. That is all anyone can do. So let me wrap this up with a final thought. If you are serious about living off dividends someday, forget about the shortcuts, forget about the 12% yields. Forget about covered call ETFs and dividend arbitrage and all the other clever financial engineering. Instead, do this. Save as much as you can. Learn about businesses, read annual reports. Understand competitive advantages. Study management. And when you find a truly great business available at a fair price, buy it and hold it forever. Your goal shouldn't be to generate $4,400 per month by next year. Your goal should be to own pieces of great businesses that will compound in value for decades. The dividends will come. The wealth will come. But only if you are patient enough to let it happen. You know, Warren likes to say that the stock market is a device for transferring money from the impatient to the patient. And he is absolutely right. The people who make real money in dividends aren't the ones chasing high yields. They the ones who buy great businesses and sit on their ass for 30, 40, 50 years. That is the secret. That has always been the secret. And it is a secret that has been hiding in plain sight this entire time. So stop looking for complicated strategies and start looking for great businesses. Stop worrying about your monthly dividend income and start thinking about what your portfolio will look like in 20 years. Stop trying to get rich quick and start trying to get rich slowly, because in the end, that is the only way that actually works.